recording here. Right, we were discussing at the end of the previous day, we were discussing basis risk. I'll just wrap up. It's quite close to this. Yeah, we need to wrap up a little bit here. It's too big. Yeah, maybe 120 is too big. So the topic here that we have is, we had already discussed a little bit, okay, but I'll just quickly run through that. So this question of basis risk has, there is a point I wanted to make about basis risk. I think I've made it at the end of the segment. I just want to make sure it's there in case I forget. Yeah. So let me put this at the top actually, because there's a term that you would see in the Halbasu book, and it's a common industry term as well. It's called cash futures basis. You remember that we saw a it is slightly different from this idea of the cash futures basis, okay, but it is also related slightly. It's the same thing. Basis is being referred to as, in this entire context, the word basis is being used in the sense of a difference between two variables, right? So if you go back to the chart that we had here, okay, so here is essentially what we are going to tell you is that basis risk is the risk that of fluctuations, adverse fluctuations in this variable. And what is this variable? It's just jet fuel minus crude oil. And so this is referred to as the basis. And so if you go back to cash futures basis, again, that was really, if you go back to your chart, you go back and check the Halbasu book, that's in the futures markets. It is in the futures markets section. You look at non-interest rate futures, that's a very specific one. It is there on hedging futures markets, and so it's this one and this one. Here to one of these two, you'll find that chart of cash futures basis where there's a convergence happening between the cash and the futures. Okay, so it's a slightly different context. But the point here, what is common to all of this, and you will later on, you will also encounter let's talk about, let's put this as a little, since we're discussing basis risk, let's put this as a little note here. The word basis appears in finance font is too small. Okay, let me not try to write such perfect English here. Okay, let's assume the English is not going to be perfect, the sentence construction. Okay, so what are those? The first is basis risk, which you are discussing here, which you will understand what we are talking about. Basis risk is a thing that arises in the context is hedging. Okay, so here what we are talking about is context. Okay, finance is all about this kind of a subject like finance or even economics. These are actually all very, very heavily context-oriented subjects, very much like law, I would say. So I'd say finance, economics, these are much more like law than they are like physics. Physics is not a context type of subject. There's no context required, okay? Your gravitational force, whether you're in Tokyo or in Nairobi, it makes no difference, okay? So therefore, there is no context required in the hard sciences. In the social sciences, is very heavily context dependent. That's why I'm very particular about the use of words. And if there is a related context, then I will bring it up and talk about it so that you know all the possible contexts in which that term is used. Okay, so the word basis will appear in three common contexts. One is basis risk, which is appearing in the context of hedging. Then the second one will be the part I mentioned here, which is cash futures basis. You can refer to the Halbasu example where you see the narrowing of the cash futures basis. Okay, so this comes up in the context of, you should actually make all this so it looks the same. Okay, that's cash futures basis. Okay, so this is actually based. Well, you can say this is when you study futures contracts. Okay, futures contracts, and this is about the convergence. Okay, convergence. Mostly, okay. We don't have to write convergence, okay. We just talk about behavior of futures contracts. It's just that the cash futures basis will converge as we get into the delivery period, because the futures is essentially for deliverable commodities. This will happen for deliverable commodities because the futures is an entitlement to, if you buy the futures, it's an entitlement to get hold of the physical commodity by asking for delivery or waiting to be delivered. And if you're a short seller and you're a long, you have an underlying long position, you're using futures to hedge, you just go into the delivery period, wait for the first position date, and tell the exchange that I want to deliver against my short. And so that's the connection. So this comes up in the context of futures contracts. And the third context in which basis risk arises is there is something called a basis swap. Okay. Okay. It's a slightly different context in which you use the term basis swap. Okay. You can have it in either. Okay, we will be studying swaps a little bit later. Okay. This relates to what we call what I have defined as capital market swap structures. So this you should be aware of this term. We don't know about the. We have not studied this as yet. We will study it in the next couple of sessions. We have only a couple of sessions left. Basis swap but you should be aware that this thing exists. So you have basis swap, which will appear in capital market swap structures. For example, okay, like a cross-currency basis swap. Okay. This is an example of a particular type of. Well, let's just write it because I think it will go over. Go over the line. We're going to call it cross-currency. When we write cross-currency basis swap in shorthand, we write it like this. Okay. Let's try it. It's still going down. We're losing a lot of time on it. Just write it like this, okay, cross-currency basis swap. Imagine losing so much time on this. Okay. So these are the three contexts in which you will see the word basis appearing in finance. Okay, and in the first two, in In 1 and 2, basis is used in the sense of so prices of futures, prices of cash market product. Okay, so it is used in the sense of a difference, and when we talk about basis risk, like I showed you that chart between jet fuel and crude oil, there again the word basis is being used to refer to the difference between the jet fuel and the crude oil price. Okay, so it's just referring to spread position kind of idea. Okay, so it is in the case of 1 and 2. In 3, it is actually used in a different context. So this shows you the problem of finance. Okay, and this shows you, this should hopefully give you an idea of how misguided it is to use so much heavy calculus, etc., in finance, because everything is very context specific. It's not really a subject which lends itself to successful, highly complex mathematical modeling. You can actually listen to, and I'm not the only one saying this, you listen to even Warren Buffett says this. If you listen to all the Buffett interviews on YouTube, they're all the Berkshire Hathaway annual meetings. It's very useful to listen to them. I think I've given you some of the lectures, links to some of the lectures. And so there are many videos on YouTube where Buffett is talking about various aspects of finance and also teaching of finance. And so you see Buffett is at some point of time, somebody's asking him whether you need a lot of mathematical sophistication to be good in finance. And he says, no. You need some basic common sense, obviously, which I like the way I refer to as basically just high school algebra. And that's good enough. So all the calculus that they use is basically no use. It's not no utility. It doesn't really help you in any real life decision problem, solving any decision problem. But the algebra is useful. It can help in a lot of ways. So you should not have a fear of mathematics. That's not an excuse for having a fear of mathematics. That should not happen. Okay. So to understand now, in 3, basis is used in a different way. Okay. In 3, basis is used you'll see this. Okay, a basis is used to connote floating rate reference. Okay. Should not ever say just LIBOR, because LIBOR is it's like saying, I got an interest rate on my deposit. What deposit? 3-month deposit, 6-month deposit, 9-month deposit. So you can never say LIBOR as such. I mean, generally you can talk about it, but when you start talking numbers, LIBOR is at 9%. What LIBOR? 1 month, 3 month, 12 month? Okay, so you have to always mention the tenor. Okay. So basis is used to connote a floating rate reference against 3-month LIBOR. Yes, what's up?
Sir, I just wanted to tell you that LIBOR is now changed by SOFR.
Yeah.
Secured overnight financing rate.
Correct. Very good. So, secure overnight funding rate, and then this the transition is still happening. You can't change it overnight because there is so many transactions still indexed to LIBOR. So the transition is happening. It will take time to transition, but they have already started transitioning. So the difference between that and SOFR is that SOFR is based on transactions, whereas this is a survey. This LIBOR is a survey-based rate, and SOFR is based on transactions. Okay. So there's a very big difference between the two. So the first one is called hard data, and so it's a useful thing. Since he has mentioned it, I'll just have a little bit of a discussion here, and so that people know this. So you can Google it and learn about it. Since he's mentioned it. Here we can use LIBOR in general because it's referring to the methodology. Transition from LIBOR to SOFR is underway. Okay. Now, what is SOFR? SOFR is, you can just Google the full form, okay? The secure overnight funding rate. This is actually, what is it? This is called hard data. So this is another term that you should learn, which is used in financial markets. So this is where we are learning jargon. Learning jargon is also important because you will be operating in the market. So it's important to know the jargon. If you come in on day one into a new job, showing that you know all the jargon, your knowledge has to be more than just jargon. But if you know all the jargon, it gives you a sense of being, it creates the impression that you're very well prepared. So this is hard data, okay? So hard data means because it's based on transactions. So this is based on, weighted average, by value. The actual amount of how much money did you borrow from, how much money did Canara Bank borrow from Citibank Bombay, how much money did Bank of Baroda borrow from IOB Madras, at what rate. And so you take all these pieces of information, which are going through the central bank database as well, and then you do a weighted average of the overnight borrowing rate, and that becomes your secure overnight funding rate. Okay, so this is why it's called hard data, because it's actually based on transactions, based on real stuff. Like, so another example of hard data would be industrial production, India's exports. These are hard data. Now, there is another type of data in the financial markets, which is hard data. What else did I have to say? Okay, hard data, let's say, based. So this is a little hard data based on actual transactions, okay? So even industrial production, India's exports, these are all based on actual transactions in that sense, because it's on actual exports, actual industrial production, so on and so forth. What is the difference in hard data and soft data? Okay, let's do this and let's have this. So this is a very good example of how student input can actually add to the material that we are covering. I was not going to cover this. I had not planned to cover this at this stage, but I think it's a relevant question since we are talking about basis. I myself did the shifting from the main topic because I needed to explain all the context in which basis appears, the word basis appears. You will notice that 1 and 2 are similar. The use of the word basis is a similar way in 1 and 2. But in 3, the word basis is being used in a very different way. It is not being used to connote a spread position. It is actually a spread position kind of spread value. It is actually being used to refer to a direct floating rate reference. So, for instance, 3-month LIBOR, you will see when 3-month LIBOR, let me give the other reference, 3-month LIBOR, 6-month, M is for month, okay, 6-month T-bills, etc. Okay, and then we have the point input from Utsav about LIBOR and the transition from LIBOR to SOFR, which you guys should be aware of this. Okay, you should be aware of this. Yeah, so as I said, I mean, although I'm still looking at it, but if you have anything important, just interrupt and tell me straight away, because I will avoid looking at the chat during the while the class is going on. Okay, the transition from LIBOR, so let's put, in this case, let's put LIBOR in caps. All right, London Interbank Offer Rate. So this is a transition because there's a massive, the trillions of dollars of loans indexed to LIBOR. So it's going to be, not going to happen overnight, but slowly they're shifting away from there. What is the main difference? You need to know all this stuff. Hard data. This is what? This is soft data. So you should also know this kind of financial market jargon. Soft data is based on survey, okay? So you go and ask people, okay, based on, in this case, LIBOR is based on a survey. So any kind of, survey data and anything else which is not based on real transactions. So if you like, for instance, you know that there's a very famous Michigan Consumer Sentiment Survey data, which a survey which is done in the US. You can actually Google that, and you can just check on that. Go to the Michigan University website and find out, because that also tells you something about how to construct the index based on a qualitative survey result, because that's also a legitimate type of research. Some of you might do that even in your marketing courses. And if somebody's doing a marketing project, you might actually want to look at what is the kind of methodology they use in the Michigan Consumer Sentiment Survey. So what are examples of soft data? LIBOR is an example of soft data, okay, which is because it's based, although it's a little deceptive, people tend to think of LIBOR as hard data, but it's actually not, because the LIBOR is an answer to the question. If you go to Citibank London or you go to Barclays London and you ask them, at what rate are you willing to lend to other AA rated banks in London today for ABCD maturities, okay? That's the answer that is being eventually averaged out and shown as LIBOR. So it's actually based on a survey, so it is actually soft data. It's not based on actual transactions. So what they're doing right now is you have basically ICE LIBOR right now, because ICE is the international, they have trademarked this name. ICE is the Intercontinental Exchange. They started as the Intercontinental Exchange. Now they have rebranded themselves as ICE, just like National Stock Exchange has rebranded as NSE. CME, Chicago Mercantile Exchange, has rebranded as CME Group. So ICE is now the rebranded. So ICE LIBOR, in the sense that these guys are administering the process now. So they've tried to clean it up because there was a scandal here, and that's part of the reason why there's a shift happening to SOFR, because people manipulated this information. You can read about it if you go into chapter 8. I think hopefully I've told you guys to look at this chapter 8. Securitization in the credit crisis of 2007. So part of the problem was when the credit crisis hit, I might have discussed this with you guys, that the banks were supposed to be in a lot of trouble. So they tried to manipulate this LIBOR rate to create the impression that their borrowing rates were not actually going up. So they were basically under reporting the rates at which they would be lending to other banks, to avoid having the impression that, creating the impression that banks were in trouble. But because actually banks were in trouble, so they were actually manipulating this rate. So there are actually criminal cases as well. There's a guy who's still in jail, a UBS swaps trader, who's actually in jail because he was instrumental in colluding with the brokers and manipulating the rate. So these are all things you have to know about. These are things that happen in the real world. This is a governance issue, an ethics issue, etc. So anyway, so because of this, now this is ICE LIBOR. ICE is now administrating this process, but it's still based on a survey. So it is soft data, whereas SOFR will be hard data based on actual transactions. Okay, so anything that's based on, so you should also know the difference between hard and soft data, where hard data is based on actual transactions or actual figures like exports or industrial production or total coal consumption in China, etc. These are all examples of hard data. So another thing you have to remember is that be careful when you are working with soft data, because it's very slippery. Sometimes you see people doing lots of very fancy analysis on soft data, but survey data is actually generally a little bit I personally find it very suspect, because if you feel, I ask somebody, these are just human beings responding to questions. Depending on the person's mood, the response may differ. Whereas if you're looking at industrial production, it's just what it is. You can't fudge that. It might be even a criminal offense to fudge the industrial production if the government is collecting the data. Okay, so that's one important discussion we had on the site. That there's a transition happening to SOFR. You can Google this a little bit. You can go to the Fed website. The US Federal Reserve, they will have a lot of information on this. And go to good central bank websites or exchange websites. Don't go to Investopedia or any random source on the web. Go to the central bank websites. Okay, so that's the first little sidelight. Okay, the transition from SOFR to this is underway. Do not worry so much about the bracketing convention. Okay, technically wrong, but there should be second brackets here. But anyway, we'll forget about that. Okay, so that's the first one. Okay, so that's a little italics to show that we're trying. That's one. So the basis is used to connote a floating rate reference, like 3-month LIBOR, 6-month treasury bills, etc. So it is. So when we say basis swap, okay, this is used as a basis swap in the context of a basis swap. So where what they would do is, if you look at the later on, I'll show you the difference, the example of a basis swap, where you are swapping between 3-month LIBOR and 6-month bills. So that's called a basis swap, where so you're changing your reference from 3-month LIBOR to 6-month treasury bills. So the word basis is obviously being used here to connote a floating rate reference. So this is an atomic level rate, a floating rate level, atomic level price, like either 3-month LIBOR or 6-month bills, and you're swapping between between this and the other. Whereas in the other two, the first two cases, basis is used in the context of referring to a spread, which is between two types of. The term that we have used is atomic level prices. Okay, so there's a slightly different. So you can see straight away how in finance three commonly used three common contexts where the word basis is used. In the third context, it's a little different from the first and second context. So that is why I say that finance is a very context-specific subject, very much like the law, and much less like physics. So, okay, so basis risk. Okay, so we were discussing basis risk. So before that, I wanted to give you a little bit of a contextual background on the word basis. So, right, okay, so this is all happening. You can go and do your, please make sure you do the research on SOFR. Go and do it from the Fed website. Okay, so this we've already discussed briefly. So basis risk is arising from the fact that because there isn't enough liquidity in the underlying market where you have your, in the market instrument combination where you have your underlying position, you decide and you want to have a liquid, you want to have it, for whatever reason, you want to have your hedge position in a liquid market. So there's the example where you have an airline which has an underlying short position in jet fuel, and it decides to hedge it does not like the liquidity of the jet fuel market, and therefore it decides to hedge in a liquid market going to crude oil. Okay, so let's see, let me read quickly here. We had the discussion on the previous day. ATF is thing, and just want to make sure I'm not missing any of the text. Yeah. So it's a decision based on liquidity, okay? Yeah, so what is basis risk? Since we're talking about basis risk here, again, as you know, I am defining risk in the sense in an asymmetric way. I'm only calling the losses, risk of losses as risk. I'm not referring to the volatility of the profit on the upside, because I'm not using the standard deviation concept of risk. So standard deviation, as you know, is a symmetrical idea. It talks about volatility on both the sides of the mean, but that's not what I'm talking about when I use the word risk. I'm always using it in the sense of adverse outcomes, the chance of adverse outcomes only. So this is different from classical finance. In classical finance theory, they talk about risk in the sense of standard deviation. Okay, so now here what I'm saying, the basis risk is therefore happening in the case of imperfect hedges, that the profits on the hedge positions, this is basically your basis risk. What is basis risk? This is your basis risk. That the profit on the hedge position may undercompensate for the losses on the underlying position, because this is how hedging works, right? So if you think that jet fuel prices are going to shoot up, if you're at this point, and therefore what you do is you buy crude oil futures, and you are already short jet fuel. So as this goes up, and so you put on your long crude oil hedge. So now you no longer have an outright exposure of short. You no longer outright short the. You no longer have an outright position, a short position in the jet fuel market as an airline, because your treasury has chosen to hedge using crude oil futures. You now have a short position where you are short the spread. Okay, here we would say you're short the spread, and the spread is defined as, now this is, you can define the spread any way you want, but then you should be consistent, okay? And I define it as short the spread, because if you see, why am I saying a short the spread? I think let's put this point here. me Okay, so where do I put this point here? How to define the spread? I think we refer to it in a little bit in a, but let's put this here basically. Let's call this, in this case, let's take the airline example and let's write it there. Okay, an example. Okay, so an ATF, and it may make sense for an airline to hedge its ADX surge through a hedge position in say crude oil futures. Okay, so here let's write it here. So airline, you don't say the airline because I want to save my typing time. Okay, so airline is goes long crude This is the hedge position to offset its short UP in jet fuel. Okay, so here you can define this way. You can, let's put it this way: the spread yeah, so this is the point to understand here, that a refinery, let's understand it with respect to the refinery. A refinery, this is the point you have to understand. What are we trying to understand? Has no outright position. Okay. Well, it's not the right way to write it, actually. If you look at it in single, in isolation, it has. Okay. Let's change the wording a little bit. So we are going to take the airline, we're going to discuss this kind of language with respect to the airline, but then you'll have to immediately switch that kind of concept or thinking to the airline example that we were discussing, okay? Because I don't want to rewrite this whole thing again for an airline. So we write this as a refinery will have, because you know what a refinery does, it takes in the crude oil, and if they don't have any E&P assets, okay, assuming they have no E&P assets, then it basically does not have a separate out where you can look at it and say, okay, you're short your inputs, and then you go and look at the output side and say, oh, well, you're short your output, you're long the outputs. You could do that, but that would not be the right way to assess risk. Okay, so that's why I'm saying what it really has is okay, you can write it here actually. We are going to write this here. Let me see if I started writing somewhere else. The spread. Okay, so we'll take this from here. Okay, so the spread is, in this case of the airline, in the case of the refinery is short input and long outputs. Okay, so we can say it's short crude, and long distillates. Okay, and distillates are all these things like heating oil, gasoline, ATF, etc. Okay. Then, okay, what it really has is a spread position. So you have to understand it this way, that you could look at the input separately and the output separately, but that's not the right way to look at it. It's not the intelligent thing to do. The intelligent thing to do is to understand that this refinery's position is really a spread position, because if you track, as you can see here, this also can be shown for, this can be also relevant, this chart can also be relevant for a refinery which only produces jet fuel. So in one chart, it is looking at the cost of its inputs and the cost of its outputs, all right? So cost of its inputs and the sales price of its outputs. So, it's straight away a refinery is looking at. Now, keep in mind, basically, imagine this, you understand different industries. If you looked at this for tonnage, if you looked at the price of gold and the price of gold jewelry, it will not be so closely correlated, because the price of gold jewelry, there's a lot of craftsmanship that's going in, there's market demand, this and that. So it will not so closely track the price of gold. Okay, so therefore you have to understand how different industries, what is their nature of their risk. This is basically the operating margin. Essentially, this is showing you for an unhedged company, a company that does not hedge. This is essentially showing you, basically it's a proxy for the operating margin, the cost of inputs and the cost of the sales, okay, on the output side. Okay, so therefore, this could also be an airline's situation. Okay, so now the question is, so what we have learned is that it could also be a refinery situation, which we are discussing right now. Why are we discussing? Because we want to make this, set up this terminology for how do you refer to your spread position. Do you say that should we say that the refinery is short the spread, or should we say they are long the spread? Now, the point is, refinery and airline have the same profile actually. Whether in this case, let's just write refinery, okay. Whether it is so we have determined that what they really have, we should not be looking at them as having separate outright positions, but we should really combine them. And why do we want to combine them? Because we understand, we see this relationship, and we understand that these are very highly correlated markets. And most importantly, if you look at the standard deviation, just as a quick proxy for the volatility, you can also look at the drawdown, etc. But if you just look at standard deviation as a quick proxy for the volatility, you will see that if you do the standard deviation of either this one black line series or the red line series, either of those two SDs, if you compare it to a third series, which you will compute by black minus red, okay, take all the values from here and do black minus red at each point of time, and then you'll have a third line, which will be running at the bottom. You can usually display it at the bottom, and you will see that the black minus red will have a much, much lower variability. You can see that visually from the chart straight away. You can see it visually from the chart. This is something else you should get used to, because again, these days we are living in an age where maybe it was always like this. People are obsessed with quantitative stuff. They want to put everything into quantitative stuff. Okay, but that's actually quite dangerous when you're dealing with human behavior, because you should understand that that is not possible, and you may have you may miss some of the important realities if you are obsessed with looking only at quantitative things. Human beings like to do that, but you have to be aware of that risk. So what was I saying? Why did I get it? So what I was saying is, so when you do quantitative analysis as well, please also make this. A very famous statistician said this. I forget his name now, and I've always felt this to be true. Also, when you're doing data analysis, please make sure you also eyeball the chart, because you're a human being. Everybody has certain talents, and some people may be more artistically gifted than others. So please make sure you eyeball the chart as well, because by eyeballing the chart, you may actually pick up certain things. I hope you understand what I mean by eyeballing the chart. And just quickly running my eyes over this and just trying to see, okay, what is the broad trend? Do I notice some funny stuff here and there? Maybe here I notice it's really tightened, and here you notice it's really wide. Okay, so this eyeballing the chart looking for any kind of strange occurrences. Okay, so like for instance, straight away this may not show up. Like if you look at your, I've shown you the crude oil charts. Okay, we'll wait for that to load. And sorry, this is not where we are. Here. So also please make it a habit to, whenever you're plotting any data, do the quantitative analysis, yes, but also eyeball the chart and try to see if something comes out and hits you in the hits you in the eye straight away as something very striking. Okay, you will usually find some insight coming through. Okay, so now what we do is the airline goes long. So whether a refinery is, so we have determined that they do not have separate outright positions. That's not the right way to look at it. But we should really look at it as them having a spread position, okay? Where they're short inputs and long outputs. Why do we say that? Because it is okay to call it a spread position because these markets, although they are different markets, they are highly correlated markets. And therefore it is okay, and we notice that the spread risk is much lower than the outright position risk in either of these two. So therefore it is appropriate, the right way to look at this refinery's risk is actually as us having a spread position rather than two separate outright positions. So now that we have determined that, now the question will arise, okay, fine, so they have a spread position, whether a refinery is short or long the spread. Okay. In this case, it's a crude oil distillate spread. Okay. Okay. We'll write it like this. We will just write, normally we'll just write crude. Crude is understood as crude oil, okay? Right? So we say this is so the question is whether we should call them short or long the spread, okay? Now the spread can be defined that is, the spread can be defined either way. That is, you can define it either way, as long as your you're consistent about it, okay? So don't start doing it one way, then you start doing it the other way, as long as you're consistent. All right, okay. But what we should do is, but what I'm telling you is, it is preferable to define first. Now we are defining the spread, and then we'll talk about the whether you're long. That will have an impact on whether you call it long, call them long the spread or short the spread. To define the spread in such a way that it's preferable to define the spread in such a way that the logic used to assess whether an entity has Entity has too much T in it. Okay. Whether an entity has a long well, let's put it this way. Again, this is not very happy English construction. We'll do it later on. We are consistent with what I'm trying to say here is you can define technically, you can define the spread however you want. Okay. So we can define the spread as crude oil minus distillate or distillate minus crude oil. But essentially here you can have, so what I'm saying is it's preferable to define the spread in such a way that when we are consistent with the logic used to assess whether an entity has a long position or a short position, long or short underlying position. Okay, and if you remember that logic, the logic was that if you are short and the market goes up, then you lose money. If you're short and the market goes down, you make money. Okay, so we should define the way. And here, what is the market? The market becomes the spread based on how you define it. So what I'm trying to say is here you can plot this as a separate third variable. You can plot it either as distillate minus crude or crude minus distillate. Mathematically there is no restriction as such. But I'm saying that whatever you define ideally should be consistent, because we have to be consistent across the entire discipline. Wherever we're using certain terms, we should be consistent. So what I'm saying is you should define it in such a way that you are going to have the same result. That means because you're going to plot the variable, right? Either this minus this or this minus this, you're going to start plotting the variable. Now, as that variable goes up, okay, and let's do the logic here. If you see, if you plot the variable as distillate minus crude, okay, so if you plot the variable as distillate minus crude, what we are saying is it's a better way to do it, because then what will happen is that if you see this going up, okay, then the airline is going to, what will happen here in this case, we say that the airline, what will happen is if you define the spread this way, but let's just look at it this way, let's just do it this way, that so the airline and the refinery will not have the same kind of position actually. So I've not equated them. So distillate minus crude oil is better. Okay, so let's define it as distillate minus crude oil. So in this case, what happens is now we can go back. Okay. Where did I start writing this? Yeah, okay. Okay. So we say the spread is defined as distillate minus crude oil. Now we come back to our question, whether now we are talking about the airline. Okay. So, because we started initially our discussion of basis risk started with the concept of the airline having this position, and it had a position. It obviously has a position in jet fuel, and it does not want to hedge in jet fuel because it does not like the liquidity of the jet fuel market. So, therefore, it goes on to hedge in crude oil futures, and therefore it creates a spread position. It creates some basis risk because the difference between the two is not going to be is not constant. Okay, so That's why there's a risk that the hedge will not make enough money, but the underlying position will lose a lot of money. All right, so that's basis risk. That's what we have defined here. Okay, so whether airline is short or long the spread. So here we define the spread as distillate minus crude oil, and now we use the same logic which we have used here. Okay, in the case of the underlying position. So if we should define it in such a way that if the spread increases, if we say that they are short, whether airline is short or long the spread, well, if our answer is short, then it better be true that when the spread defined like this increases, then they lose money. If they're short, they will lose money when this is now the new market. Distillate minus crude oil becomes a new market. That becomes a new KRF for these guys. Okay, you plot it here, distillate minus crude oil, and that becomes a new KRF for them. And now the question is, are they short or long? Well, let's look at what happens to their PNL if the KRF goes up, KRF value goes up, and the KRF value goes down. So in this case, as you can see, what will happen to the KRF value, as you see, if the KRF value, here's an example where if you see compared to this, let's look at this, which is why I picked this place for the point where they hedged. Their underlying position, the airline underlying position is short jet fuel, and the hedge position is long crude oil. So from this point onward, they don't have the short jet fuel position, they have a spread position. But now you focus on the value of the spread. We are not doing the mathematically doing the numbers, but we are just eyeballing the chart. And you can clearly see here that the rise in the jet fuel price is more than the whatever was the value. Say if this was the value of the spread at this point was, let's say, $3. The value here is probably more like $5 at least. Okay. So, much more than that actually. And if it's 3, then it's probably almost $8, $9 kind of spread. Visually, we can see that. So now what has happened? The spread has gone up. Okay, the spread as we defined it, output minus input, is now the value of the spread, which was $3 here, is now $9 here. Okay, so and what is happening to the airline's PNL from here to here? The this thing has gone up by $6 more, and this thing has gone up. Okay, so this thing has gone basically from here to here. So the increase in the jet fuel price is much more than the increase in the futures price, the hedge position value of the hedge position, because the futures, you bought futures here, so you're making a profit from here to here, but the underlying position is showing a loss from here to here. So the rise in the underlying position is much higher. So as the spread, the value of the spread, as we have defined it, the value of the spread increases, the airline is losing money, okay, because the hedge is not compensating. So in this case, therefore, we would say that the airline is short the spread as defined, okay? So the spread is defined as distillate minus crude, so we can just generally call it output minus input. And so the airline is short when the spread is going up, okay? And the airline is losing money when the spread is going up, and the airline is making money when the spread goes down. Here you can see that as it collapses here, from here, if you compare from here to here, the crude oil prices have, jet fuel prices have fallen much more than crude oil prices. So the loss on the hedge position is much less than at this point itself. You can compare it if you want to take extremes. Now you see the difference, it's much, much lower. So the jet fuel price has fallen much more. So the increase, or let's say the reduction in the loss on the underlying position is much more than the loss that is being realized on the long futures hedge. So therefore, in this case, from here to here, there is a benefit. Okay, so the spread is coming down, and these guys are benefiting, so they're short the spread. It confirms that. So in this case, we say that they are short the spread. Okay, so it's just something that I spend a lot of time on this very basic stuff, but these are all things that you have to think about as to how you are going to set up your this is like really the ontological environment in which you're going to operate. So these are just all these things that you have to be clear about. And then once you set it up, you should be consistent. Okay. So we say that the airline is short the jet fuel, the distillate minus crude oil spread. Okay. You notice something else. In the case of the refinery, what happens? Let's again go back to the refinery, and let's assume that we have defined the spread like this: distillate minus crude. So in the case of the refinery, what is happening? Is the refinery long the spread or short the spread? Anybody has any ideas while I take a sip of water?
Sir, long the spread.
Very
So
good.
long.
Okay, very good. The refinery is long the spread because if the spread can increase in three ways, either outputs go up and inputs are constant, inputs fall and output is constant, and both of them happen together. Inputs fall and input prices fall, output prices go up. In all three cases, the spread will increase. And in all three, they're beneficial to the refinery because input prices are going down. They're making more on the outputs than they're losing on the inputs. So therefore, their profit, their operating margin will go up. So in this case, you see the difference here that if we define the spread like this, we say that the airline is long the spread, sorry, the refinery is long the spread and the airline is short the spread because the airline is getting hurt when the spread increases and benefiting when it goes down, and the reverse is true for the airline. So, for the refinery, sorry, I keep getting confused with the two. Okay, so here's a little bit of a discussion on the whole concept of basis risk. Now you understand what basis risk is. This is basically this is essentially basic. You can see the whole thing in one picture. If you want to explain to somebody what is basis risk, you can explain it through this. Take the case of an airline, is short jet fuel underlying position. It is worried about jet fuel prices rising. It wants to hedge, doesn't like the liquidity of the jet fuel market, wants to take a very closely correlated market, but much more liquid, crude oil futures. So therefore, it goes and hedges by buying crude oil futures. Now it's got a long hedge position in crude oil futures and a short underlying position in jet fuel, which is a spot market. Okay. So all those Indian oil tankers will drive up to the airlines, to the aircraft and then fuel it before it takes off. Okay, and they'll have to pay Indian oil on whatever term. So we assume there's no credit term, so we take it as a spot exposure. Okay, so even if it's a credit term, we will still take it as spot exposure because the credit interest costs and all will be built up, and the price will be the spot price on that day that Indian oil is going to charge the airline. Okay, so but you see, even after they put on the hedge, there's a dramatic movement in the jet fuel price. The rise in jet fuel is much higher, and the rise in the futures prices correspondingly in comparison is much less. So the hedge is not compensating 100% for the losses on the underlying position. So this is basis risk straight away. In one picture, you can explain to them what is basis risk, and this is what is the basis here. The basis we have defined, we will define it. It's better to define here as crude oil minus, as distillate minus, output minus input. And we would say, so what are all the elements of our ontology that we have covered just now? The idea of basis risk, the various contexts in which the word basis is used in finance, all the different contexts in which we use basis, and then we went into the discussion between LIBOR and SOFR, what is soft and hard data, etc. And then we came back to basis. Why do we have basis risk? Because of the decision that an airline takes, that a particular entity with a passive risk book takes with respect to the market in which it will execute its hedge. Okay, and then you end up with an imperfect hedge. And then you have a spread position, and you define the spread in this way. And then you have to talk about whether they are actually what is the actual position in the spread. With respect to the spread market. And here, the case of an airline, the position is short the spread, and the case of a refinery, they are long the spread. Okay, so these are all the things that we've just covered so far. Okay, you can see once again, as I said, I can understand people getting bored, but you don't have the right to get bored because you have signed up to be finance students. You see how much material we have covered in such a short period of time. Okay, why is that possible? If I had gone around the class asking everybody questions and done it in the case method, you can do this stuff also with the case method, but it will take you a lot more time. Okay, and I'm not exactly sure how much extra benefit there is, because if we can assume that the students are highly interested, which you should be, okay, and then it's much better to do it this way, because I'm just throwing concepts at you and you are trying to understand the concepts, and if you have an automatic problem, if you have you straight away realize you can't, if something is not clear, you ask a question. Otherwise, you go back home, revise, and then you may still have further questions, and that's how you internalize it. And bang, bang, bang. In this manner, you have covered so many concepts, so many more concepts than you could cover in a case method with the case method approach. Okay, so this is just my view. So this. You can have it'd be actually good to ask later on. Maybe we should do a survey of the students and find out from them what method they prefer. Okay, because I don't think too many people have done that. So anyway, for what kind of material? So we have covered all this material. I was just doing a recap for you. Okay, so remember, this is basically this is what is basis risk in the context of basis risk is used in the context of hedging. Okay, so let's cover further here. Right. Okay. Now, if you remember, Siddharth was hinting at this a little bit. Okay. I don't know if this thing is still available. Maybe I got this chart from there. Okay. Okay. I was referring to I was wondering where that chart is. This is a very nice chart, actually. Yeah, it's a nice chart, actually. This is, you guys can look at it. I was referring to this. I think this is the one which shows the cracking process. Okay. Yeah. There is a chart. I think I must have put it here because so this stuff is very good, actually. Those who want to be, if you want to be an oil and gas analyst, all this stuff needs to go into your brain and get embedded there forever. I don't care whether you're a science student or not. It's not that complicated. Just learn it. If you want to be specializing in oil and gas, somewhere there should be you can see all these these are all outputs. Okay, so you're just putting the crude oil in the refinery and you're heating them. Here, this is the one, actually. I had this picture in my head and I wanted to share it with you guys. I was wondering where it is, and I myself forgot where I put it, actually. So it is there as a picture from here. Okay. All right, so you can just look at it. This is what I was talking about, right? You put in that input crude oil, and then you get distillation, and then you have low boiling point to high boiling point. You can see, this is where it is. Kerosene is jet fuel, as I told you, okay? And these are all the other distillates that are happening. We refer to all of these as basically distillates in general. Loosely, that's why it's called distillation, okay? So this is stuff, you guys can read it on your own, okay? If you want to you specialize in oil and gas and become it's a very important sector. I think even with all this renewable energy stuff going on, it's not going to be easy to give up on fossil fuels. Okay, oil and gas is going to be around not just for my lifetime, for your lifetime also. I think it'll be the major source of energy. So there is something to it is always worthwhile if you're fascinated by the sector. Try to become an oil and gas equity analyst, and then you can also parlay that skill into credit analysis. Okay. All right. So what is this? Okay. So the point that Siddharth was asking about, why should they do it in the previous class? If you remember, I think he was asking about something like this: that why should I hedge in why should I hedge in crude oil? Why don't I just hedge in jet fuel, etc.? That's basically, so it's a valid question. So as I said, it's not a clear cut. I mean, it's not a mathematically correct answer either way. Okay. So essentially, what is happening is these guys are facing a trade-off. Okay. So your option is either you do the hedge in a highly liquid market. Okay. You have liquidity. So let's take the example of the airline, okay? So it has an underlying short position in jet fuel. Now the question is they want to hedge. Now the question is, should they hedge directly in the jet fuel market? Or should they hedge using crude oil futures, which is much more liquid? So if they're looking at crude oil futures, it's a much more liquid market. High levels of price transparency, okay, partly because it's an exchange traded market. But price transparency now is not such a big differential between OTC and ET, because even in OTC FX, as you saw, I showed you that Net Tanya web page, those are tradable prices now. Because OTC FX is such a popular market that even though it's an OTC market, you can have very high levels of price transparency in OTC FX as well, because it's a very liquid market. So with the advent of the internet, some of the difference based on price transparency between OTC and ET is now much less. Okay. But the main problem is liquid, high price transparency, crude oil futures, but it's not the market in which the UP exists. Okay. And therefore you have underlying exposure, and what that means is basically that there is going to be basis risk. Okay, so if you do this, it's not the market in which the UP exists, and this basis risk is going to exist because this chart. Where is the chart? Yeah. The moment you do this, you have underlying position here, you hedge in this market, you're going to be faced with basis risk. Sometimes it goes against you, sometimes it works in your favor, but you have no way of knowing which is going to happen. Okay, like I say, when people ask me what is my view on the market, I say, like some people, it's a popular joke that you say that the market is going to go up and down, but not necessarily in that order. Okay, so that's a way of joking about the fact that nobody knows what's actually going to happen to the market. So the point I'm trying to, that there is a trade-off. Okay, remember, all of economics is based on trade-offs. Okay, scarce resources, if you remember your economics. And if you remember, I have given you guys, please remember, go back and check in your lab notes. I have given you a link to a very good economics site which has a non-mathematical treatment of very important micro and macroeconomics. Remember, as finance students, you have no excuse saying that this is economics, it's not finance, I don't know. No, you have to know your basic macro and microeconomics inside out if you're a finance student. So I would recommend, if you have not done so already, go back to your lab notes, look up that chart, look up that link. Okay, there is a link to economics, very good treatment of economic concepts in a non-mathematical way, which I think is a better way of doing economics than doing it, because that forces you to actually think about things. In mathematics, you can do it mechanically without really thinking much because you know how to do the maths. So I prefer that. So remember that you have to go back there and do it. Okay, so all of economics, if you remember, scarce resources, you have trade-off. If you use your money to open up a cafe, and then you can't start a software trading business, maybe you have a limited amount of money. So therefore, there's always a trade-off. So there's a trade-off here. The hedger is faced with a trade-off between this is the trade-off. Okay, either you do it here or this. Okay, and so basically what we say in a stylized finance insight kind of sense, what we say is he's trading off. There's a trade-off between the accuracy of the hedge. Okay, or you can sometimes call it the effectiveness of the hedge, etc. Okay, accuracy, where high hedge accuracy means low basis risk. So you're trading off the accuracy of the hedge versus the transaction. There's a trade-off between accuracy and the transactional efficiency of the hedge or the liquidity of the hedge. Okay, so liquidity, the fancy term for that we say is that the hedge is more transactionally efficient because it's a much more liquid market, especially if you're running a dynamic hedging program, hedging, unhedging. Okay, it makes much more sense to hedge through crude oil futures because it's a much more liquid market. So what you're doing is you are just, even if you're not planning to run a dynamic hedging program, you may decide to hedge in crude oil futures because who knows what might happen. At some point of time, you might have to take off the hedge for some reason. So therefore, you just want to be located in a much more liquid market with respect to your hedge transaction. So essentially what we say, this is a trade-off between the accuracy of the hedge and the transactional efficiency of the hedge. So here to highlight the trade-off that exists, okay, transactional efficiency versus trade-off, okay, accuracy versus transactional efficiency. Okay, accuracy means accuracy would come if you hedge like what Siddharth's first preference seems to have been, that why not directly hedge in crude oil? That would be a very accurate hedge, although it may not be transactionally efficient. But if you hedge in crude oil using crude oil futures, then it's transactionally efficient relative to the jet fuel hedge, but it is not accurate because it has high basis risk. Okay, but well, even if it's high basis risk, but I mean, it has some element of basis risk. Whether high or low is depends on how the stuff moves, okay, or how it is expected to move. So it is essentially that depends on what actually happens. But there is basis risk. The point is that there is exposure to the basis. All right. So as I've said here, as I was answering Siddharth's question yesterday also, that this becomes more important when you're running a dynamic hedging program. Okay. Yeah. So this, although I'm writing it here, yeah. So here we said that this we have already discussed. Okay. So that we are saying that the guy, what font is this? Everything is now become, the font has become all confused, okay? So let's stick to Times New Roman, because sometimes when I go to Meriwether, the hyperlinks disappear and the formatting disappears. That's very strange, actually. Whatever. I mean, the style thing. Okay. So here we have, it changes a little bit. Meriwether is a bigger. Where did we go? And we're going to the project code. We should start the. Yeah. So there is a spread. This we have already discussed, that there is a spread position. Okay. Okay, and then we you can here you can say. Actually, yeah, okay. So there's an optional reference here to cross-hedging in Halbasu. Okay, quickly let's go through the let's go through now your hedging logic, because we will right to start the program, the hedging program. I will let you know when you start, okay? Because we are still waiting for Vipul and Ketan to get their new accounts. Hopefully that works. But the plan is to start from next week. Hopefully on Monday itself or on Tuesday, I'll send you guys a communication, and then you can start trading. Obviously, it's going to be a very, very short project, but we can't help it, as I said. Now, these are some of the things that you guys can give feedback to the director about, that whether it's worth doing it in a different way, because your learning is being truncated because the project is short, because we are cutting it short, and we are seeing a trade-off between releasing the grades on time versus getting the maximum learning from the project. Now, I would solve this trade-off by saying that releasing grades on time is not a big deal. Forget it. We'll release the grades later, but let's get the learning out of the project. But ma'am has decided to solve that trade-off in a different way, which is fine. Different people can have different value systems. So, but then you can always mention to the director that this is, if you feel that this is something important, you can always mention. And these are the things you guys have to express your views. Although your capstone, lots of problems with capstone or something. If you have a problem, you have to express your views. Okay, that whatever is the whatever your feelings are, you have to express them. Okay, where are we? Decision problem. When I want to go back to basis risk, we have finished the basis risk. Okay, let me quickly run through the hedging logic, okay? So because you're going to be starting everything, I'm just mentioning this. It's all written here. You don't have to really. And then we'll start with swaps from the next class, because swaps is not really required. Okay, please remember here when you're hedging you will be doing your project with only 5 KRFs. Although conceptually you have to understand that there are 6 KRFs. Okay. As I remember, Srishri mentioned about that dollar 3-month LIBOR. Okay, it's a floating rate loan. But as far as your project trading, now we are focusing on the project trading. You just treat 5 KRFs. Okay, 1, 2, 3, 4, and 5. Okay, these are your KR 1, 2, and 3 here. Okay, 1, 2, 3. These are your 5 KRFs, and you have to hedge them using futures contracts. What is the logic? Let's try to just quickly run through that. We are running out of time, but I'll just tell you. Okay, here's you can read when you read this, you'll understand. Okay, your net PNL is UP PNL plus HP PNL. Okay, you have to maximize the profit or minimize loss on net PNL. Now, unfortunately, the two parts of the net P&L, UP and HP. Now you can't do anything about the underlying position P&L. What's going to happen when the project starts is, when I give you the green signal, that day I will take the previous night's figures, these prices that you have, okay? These are project start prices, okay? So as you know that obviously the net worth figure is a function of what prices I'm plugging in here, okay? If I change the prices, then obviously if I make this collapse, your net worth is going to go down, okay? From 2.37, you can see net worth will collapse, okay, to 2.1, okay? So this is going to happen. So this is a function. So your net worth is the focus, as it should be, and this is basically affected by these. That's why these are the KRFs. Okay. Now you can't do anything about this. So before I start the project, when we start the project, I'll take the market closing values in New York, the previous nights, and then I'll put this down. I'll freeze this spreadsheet. Okay. Then we will know the starting net worth. Okay. Starting reference for dollar net worth is this. Okay. And then what's going to happen is then your project period starts. Of course, as Sachin pointed out, it's a very, very short period. That's unfortunate. You have to understand that we are operating under the constraints, but ideally we would try to imagine that we are doing something like for the long term in a serious corporate treasury setting, because everything else is the same. It's just that you'll have very little time to do your project. But you can still imagine that you're in a corporate treasury and try to get the maximum learning out of it. So what's going to happen in the corporate treasury setting and your project is you can't touch this stuff. Okay, you can't touch the economic exposure balance sheet and all. You can't influence the factors that are driving the numbers on these on the economic exposure balance sheet. You can't tell the sales team, hey guys, why don't you quickly sell some stuff? You know, I don't like this risk. So the sales team cannot be disturbed like that. They need to do their business in the normal way. Similarly, you can't tell the production team, guys, please speed up and let's produce some more copper, etc. You can't do that. Okay, so you can't do anything about what's happening on this. All you can do is keep a track of it. You should be aware of what's happening, your exposures. Okay, if the starting figure is 2.5K, in your project it will not change, but in real life it keeps changing. Then after 3 weeks, if the inventories have gone up, then you have to update the figure and make it whatever 9.5K or something like that. You have to have the latest figures at every point of time. So you can't touch this stuff. At the same time, this movement in the underlying position P&L is affecting your net P&L. And as you know, what is happening is, as these prices fluctuate, your net worth is fluctuating. And you feel helpless because you can't do anything about it. You're watching it. So what you don't have to feel helpless. What you can do is, you can now set up your hedge positions. You can set up your hedge account, okay? And you can manage your hedge position in such a way, sorry, that you can read it here. Yeah, what does this mean? You need to focus on this, because you can't do anything about UP. UP plus HP is what you're getting affected by. You can't touch the UP, so you got to play around with the HP, the HP P&L, okay, the hedge account P&L. And how do you do that? You basically affect the total position. You do it here. As you can see, oil prices are going up because there's a lot of cancellation happening. A lot of oil. There's a new administration in the U.S. is causing. This is West Texas is a North American crude. Okay, this is where your politics comes into the economics and the financial market analysis, because Biden is actually against all the fossil fuels, whereas Trump was very much pro fossil fuels. You have to understand how political changes have a massive impact on financial markets. And this is a very important market, of course, crude oil. And you can see how crude oil prices are going up because they already canceled the permit for the Keystone pipeline. That has massive repercussions even in Canada. There are thousands of jobs being lost. But that's just job loss, but there's an impact on the crude oil price because it's going to have a negative impact on production. They are also halting crude oil leases, okay, on federal lands. Fracking leases for gas also is going to get affected. So prices are going up, okay, in this environment, all right? So this, you have to understand the connection between politics, and don't just look at the market in isolation. You see, you have to understand how the politics is and the different policies of different political parties with respect to sectors like crude oil and all this climate change and all this kind of stuff, how it has an reality, because Trump was not a big believer in all this climate change stuff. His focus was on energy independence, okay, because it has massive strategic implications for the U.S. If the U.S. is a energy independent country, then it can do lots of things in the Middle East. It doesn't have to, pander to the oil-rich Middle Eastern countries. It's an oil exporter in its own right, so that gives the U.S. massive flexibility on the Middle Eastern policy. So you have to understand all these connections, okay? How the political views and how political views connect to economic output, economic impact, and then how it has a geostrategic impact in the foreign policy, etc. You have to understand all this because this is what the real world is, okay? So you have to understand also, play around. Basically, if you feel oil prices are going to go up, then why should I hedge? My underlying position is long oil and it's going up fine. I'm not going to hedge right now. My decision problem is DP5, to enter at market or to enter at prices better than market. Now, if I take the view that this stuff is going straight to $70, so why should I hedge now? I'm going to wait. That's your value addition as a hedging team member. This is where you're adding value. Instead of blindly hedging here at 55, you are so smart, you can see the move to 70, then when it goes to 70, then you hedge, and then the price collapses. And then you can tell your boss, look, I'm so smart, I hedged everything at 70, and then the prices collapse to 30. So your production realization is locked in at 70. Your whatever inventory you have. And so this same logic is going to be applied. I'm rushing it now because we are almost at the end. So you understood what logic I've given here. Exactly the same logic will apply for everything else. But of course, you have to be aware of what is the position. In the case of dollar yen, in the case of Aussie, your position is not long, it is short. So you have to then flip the logic around. But it's the same thing, as I said. And then you can also read this. Please read all this. Everything is given here, okay? And I'll just tell you one more thing. I'll just cover one second. Okay, very quickly I'll cover this. The golden rule of hedging, as I told you, that JP Morgan, the London whale fiasco, they did not follow this golden rule, okay? This is the golden rule. Everything here is, you can just read this stuff. It's the same thing, same stuff that I just told you, okay? Take a view on the market and see what is going to happen. Be aware of your underlying position and then take your DP5 decision accordingly, okay? Either hedge directly at market or put a stop below wherever the current market is, or you put a sell limit at higher levels because you see it going higher. Now, quickly I'll just do this. Golden rule of hedging means, as we have already discussed it, okay? Your total position cannot go beyond the ranges, okay? We have discussed some positions. Yeah, your total position here, in this case, you started with a long position of 25. So your total position must fluctuate between, this is not allowed, okay? This is not allowed, okay? So this, let me put a little red here, not allowed. You must stay between the initial amount of the position and the zero, okay? In real life, initial amount as updated by new production or sales figures, or new loan figures or new loans taken, etc. Okay, everything is clear. This is all fine. And of course here, and if you notice the language here, between zero and the amount of initial underlying position, amount can be positive for long underlying position or negative for short underlying position, okay? But the main point you understand, if you can understand it with the long side, it's easier to understand, I think. Then you understand with the long side, then you'll understand the golden rule of hedging for the short side. Because in the case of Aussie, your position is long, is short actually. Your UP is long, is short. Okay, so I'll just quickly wrap up. I don't want to cut down your time in the next. For short UP, yeah. So the amount can be negative for short UP. Okay. So in this case, in the case of Aussie, it will fluctuate between. There will be a minus figure here, and then it will be zero. So it will be now. If you're short, in this case, how much are you short? You're short 2.5 million Aus. Okay, so this figure becomes 2.5 million Aus. So your total position can fluctuate in Aussie between 2.5 million short. Of course, you have to, in real life, we're ignoring the representing the future interest cash flows. We're ignoring that. In real life, you will not ignore it. But in the case of the project, you can ignore it. Okay, you just hedge this 2.5 million because additional the total exposure is increasing. It is on top of that. This is only the P. Then there's the P plus I. So in the project, you don't have to worry about the I. You just hedge the P. So remember, this position is actually minus 2.5. So the total position in Aussie has to fluctuate between minus 2.5 and 0. Okay. All right. So I have taken how much? I've taken 3 minutes extra. Okay. So you can leave now. And we will, if there's any conceptual question, I'll answer that, and then I'll talk to the, I'll talk about the, I guess, capstone related or any other administrative matter. Okay, no problem. All right. Okay, fine. What I don't know what Nikita sent a direct message or something. I didn't. I just crossed it out. Anyway, okay, guys. There may be an internet problem at my end. I don't know what is happening. But any conceptual question?
Yes, sir.
Class is dismissed. You can go. Those who have questions can stay. The rest of you can go. Yeah. Yeah. Go ahead.
Sir, I was saying that when we were studying the short and long positions for airline and the refinery today, sir, can we say that it depends upon the input we are having? Like you said that we have an option, we can flip both the, what do we say? Could you please come to that part?
This one or
Yes, sir.
the chart.
No, sir, slightly. Yeah, this thing. Sir, when you said that airline is distillate minus crude oil, and in the case of refinery, we said it will be same distillate minus crude oil. But so we can we say that what our input position is, our underlying position is dependent on that.
Yeah, you can say that. You can say that. Yeah, we'll see some example application of this rule also in the case of well, what did you say just now? I mean, what were you saying? No, it's just that what I'm saying is it's better to define the spread. The spread definition remains the same whether you're talking about an airline or a refinery. The definition of the spread remains the same. It should be distillate minus crude oil, or output minus input, if you want to talk about a more general sense. Okay, output minus input. Define the spread in this way, and then you find that the airline, the variation comes in how you assess the exposure of the airline or the refinery to the spread. So you define the spread as distillate minus crude oil, and then you see that the spread, when the spread is going up, the airline is losing money, and when the spread goes down, the airline is making money, so the airline is short the spread. And similarly, in the case of the refinery, the refinery is long the spread, because when the spread goes up, they make money, as defined here. When the spread goes up, they make money, and when the spread goes down, they lose money. So they are long the spread. So what were you saying about the input side? You're trying to correlate the position to the input.
Yes, sir. Yes, sir.
See, in the case of the airline, we see it doesn't work like that, because in the case of the airline, there is no output as such, because I mean the output is ticket prices. You see here, input output makes sense only for refinery case, okay? Because the refinery is directly showing both the input and output prices. Both the input and output prices are actively traded in the case of a refinery. But if you look at it now from an airline point of view, their output price is actually ticket prices. So that's not being sure. That's not an actively traded variable. So I think in general it would be better not to talk about the input-output kind of format, and then correlate it to the position in the input or the output, and then connect it to the position in the spread. We just think about it this way, that we define the spread in this manner, distillate minus crude, and if we define it this way, we basically, and then we have the airline position is short. The main learning here is that if you are saying that a particular type of entity is short the spread, then depending on how you define the spread, we should be able to see that when the value of the spread, because you can plot this difference over here at the bottom, okay, as a smaller panel because the variation is much less. And we see that whenever the spread is increasing, this minus this is increasing, that's hurting the airline. And whenever the spread is decreasing, it is beneficial for the airline. So spread is going up, they're losing money. Spread is going down, they're making money. So this must be a short position. So therefore, we will say that the airline is short the spread. I think we should just remember this much. I mean, just understand this much. Not so much remember, but understand only this much. That we define the spread in a particular way. And then when we are talking about the position of an entity with respect to the spread, long or short, then we should say it in such a way that when the spread is going up, the person, if we say that the entity is short the spread, then it must be true that when the spread is going up, the airline is losing money, and when the spread is going down, the airline is making money, because that relates to the logic that we had earlier. Okay, the logic we use to assess whether the entity has a long short underlying position. Because remember that logic which we used, an answer that Utsav gave in the class that day, that how do we decide whether it is underlying position is long or short? We figure out whether they're making money or like losing money when the price goes up. And then accordingly we decide whether it's long or short, right? Is this clear now, Krishti? So just think about it this way, okay? That the spread is defined, in the case of crude oil versus jet fuel, we define it as jet distillate minus crude oil. And then we say the airline is short, but the refinery is long. Okay, so in this case, what we say is the airline is long. Here, airline is short.
Okay, sir. And one more thing, sir. Sir, if we flip it, if we say crude oil minus distillate, so will the positions flip? Like positions will also flip in that case.
Yeah. Okay, 1 minute. Okay, let's see 1 minute. Okay, let's just see if that is there anybody with that, because you have another class now after 15 minutes, another 5 minutes. Is there anybody with the administrative question?
Yes, sir.
Okay, Kanika has an administrative question. I'll just pause and we'll go back to Srishti. Yeah. So Srishti wants to do this as this is what 2, 5. So we do this as oil and ATF. All right. Okay. So let's say ATF prices is 80, whatever, 80, 95, 50, 45, okay. And oil prices are, let's say, 75, then 87, 95, 135. It is caught up a little bit, okay. So then we define the spread as JF minus CL, okay. And we can also define the spread. This is what you're saying, right, Srishti?
Yes, sir.
Okay, let's do the exercise also. And I was also wondering about this actually, how it will look. I just generally prefer the JF minus CL. Okay, so let's look at this. This is now causing. See, Google is so smart. Google is smarter than me. I should have followed their input. Well, anyway, they are so smart. They know where that I wanted to take this down. Okay, now let's see if I can keep up with Google's IQ here. Yeah, suggested autofill. Very good. See, these guys are so smart. Okay. All right. So this excess scenario we've already covered, right? That
Yes, sir.
the spread is increasing. So let's just focus on the airline side now. The airline side. Let's focus on the airline side now. The airline's kind of outcomes. Okay. So we have, as the spread is going up, the airline's getting hurt because prices of jet fuel have risen a lot, but the crude oil hedges are not rising that much. So the hedge position offsets the losses on the underlying position, not by 100%, but by much less. Okay, so that's a problem, and that is reflected in the hedge, the spread going up. We have defined the spread this way. Okay. So in this case, what is happening? The spread has gone from, is this, minus 20 again. So, and if we define the spread like this, what is happening is the situation is the same. In the sense, we stick with the airline situation. Now we are asking ourselves, what is happening to the airline at all these different points of time as we move from here down here? Okay, let's make this even worse actually. Let's make this continuously increasing so that we have a monotonical set of outcomes. Let's see. Let's make this like, I want to increase the spread. So let's make this 12. Right? Now this is what we want. Okay. So here we have a monotonical increase in the spread, and here what is happening is there is a decrease. See, remember, if you plot this, what I was talking also about the visual side. Okay. What does it look like if you plot this? The line is going further and further down. You see that?
Yes, sir.
Yeah. So in this case, the line is going further and further down, and you are actually hurting. So in this case, you can say you're long the spread if you define. That's why I said there is no restriction as such mathematically. Okay. But the line is going down and you're hurting, so you would say in this case you are long the spread as defined in this way. So there is actually no way to, so the preference that I expressed in the note is only a kind of a subjective preference, because based on how I have used it in my own industry career. So it's just a historical hangover, but technically there is no difference as such. Okay. That because all it has to do is, then in this case you have to say that the airline is long the spread, because as the value of the spread declines, the airline is actually getting hurt more and more, and so therefore this will be described as the airline being long this kind of spread. Yeah. Does that they're being long the spread as defined in column F, but they are short the spread as defined in column E. So I'm saying that you can do either, but you have to be consistent. Yeah.
But sir, won't it be short because as the prices are going up, the losses of airlines are increasing. So won't it be short?
No. Because your long and short has to be assessed with respect to your P&L outcomes as a function of the value of the spread. If you plot this, obviously you'll see a line that is going up, right? If you plot this, you will see a line that is going down. So you have to now focus on the spread value, not on this or this. You have to focus on this, becomes a variable in itself. So if you are looking at a refinery, let's say if you're managing risk for Reliance Petrol, and we don't have all kinds of restrictions on India's crude oil imports and all that because of duties and all that distortions which affect the price. Otherwise, they would be, if it's a free market, they'll be buying oil on the international markets and selling in India. The Indian oil price would be connected to the international oil price, because whatever happens is passed on to the output prices. In that case, you would be defining Reliance Petrol's KRF as the spread, the jet fuel crude oil spread. Now you can, for your purposes, you can write it either this way or you can write it this way. It doesn't make a difference, but you have to be consistent. But the point is that if you write it this way, then you will say that Reliance Petrol is long in this case, you will say they are long the spread, because as this is happening, Reliance Petrol is doing better and better, right? You see that? Because output prices are going up much more than input prices. So Reliance Petrol is doing better and better. But Ryanair or Vistara is doing worse and worse in this category. Is this clear now? Christy?
Yes, sir.
Your KRF is now the spread. So all I'm saying is you can write the KRF however you want, either this way or that way. But if you write it this way, then what you are locked into is, if you write it this way, there is no way for you to say that Vistara is long the spread. Because once you have defined the spread like this, I will chart the spread. And it will show that as crude oil, as ATF prices are going up disproportionately more than crude oil prices, where the hedge is, then it is bad for Vistara. So as I plot the spread, and the spread value is increasing and it is bad for Vistara. So here, what I'm saying is what you absolutely cannot do is say that having defined the spread like this, you can no longer say that Vistara is long the spread. That's all I'm saying. Is this clear?
I don't know, sir. I think I'm confused at this point. I'll think about it again.
Yeah.
And if I have any problem, I'll get back
Yeah,
to
yeah.
you.
See it again and see. Basically, the point that you have to understand is now your KRF is only this. If Vistara has decided to hedge using crude oil futures, okay, you forget about the distortions in the Indian market and all that. Assume that we are actually operating in a free international market. Okay, in that case, if you know that Vistara has hedged using crude oil futures and you have chosen to define, as the hedging team manager of Vistara, you have chosen to define your spread in this manner, not in this manner. You have defined the spread like this, and this is your KRF then. And so all I'm saying is that if I'm the CEO or something and I want to know how you're managing the exposure, you can't tell me that the Vistara exposure is, Vistara's position is short the spread, is long the spread, because it is actually short the spread. As you defined it, the spread value is going up and Vistara is losing money. This cannot be a long position. You understand what I'm saying? That's all I'm saying. Nothing else.
Yes, sir.
That's all. Basically, just think about this. That depending on how, once you define a spread in a particular way, and given the profile of either airline or refinery, you have certain restrictions as to what you can say about the position. The spread position. Are they long the spread or short the spread? You can't just say whatever you want. This whatever you want can be applied in this stage, at this stage, where you can define the spread however you want. But once you have locked yourself into a definition of the spread, then you can't say whatever you want with respect to, if I then lock in the type of player, airline or refinery, then you don't have the flexibility to say whatever you want, that they're long or short. Because if it's an airline and you have defined the spread like this, then that airline is period short the spread. There is no other way to put it. This is clear. You think about it?
Okay, yeah, I got it, sir. Actually, sir, their input is there. They are facing losses on their inputs and output. Like considering an example, they are facing losses in inputs and output.
Don't think of output and input, because output for airlines is ticket prices. Don't think of output input. Think of the actual variables in the spread. Think of the actual variables in the spread. Like Tata Exports could be, in this case, it would be soybean meal, and this would be soybeans. Okay, so soybean meal is coming out of the soybean processing, and the process, the input in this case, don't use the word input and output. Just look at the top, use the, I may have confused you by talking about input and output, but don't use it for this kind of analysis. Talk about the actual variable. Okay, so
Yes, sir.
okay, talk about the actual variables. All I'm saying, remember what this, you can play it back and listen to it, that you have flexibility as far as the definition of the spread is concerned, mathematically. But once you have defined the spread and given the type of player that you're talking about, airline or refinery, you do not have flexibility to talk about the position as either long or short. If you define the spread in a particular manner, then once I give you the name of the type of entity, then the answer is only one right answer. That is, the airline is short the spread and the refinery is long the spread in this column, and the reverse in this column. Got it? And that is true because the short long has to be consistent with our logic for deriving underlying positions. That means if the market is going up, now this is your new market. The KRF market here is the spread market. The spread market, as the spread market is going up, the airline is losing money. So therefore the airline must be short. That's all. You listen to it once again, you will understand.
I got it, sir. I got it.
Yeah.
Actually, our spread are increasing. Yeah, I got it, sir. When our spread is increasing, and when we've decided that the crude oil with respect we are considering our position, uh, and the spread is increasing, so our position is definitely short in that case.
Yeah, the spread. You have to understand your new position is the spread. Once you have hedged as an airline using crude oil futures, you no longer have positions here. I mean, you do have if you look at it separately, but the real position is over here. And you have to monitor the value of the spread and take a view on the value of the spread. I mean, because once you have hedged, you don't have anything more to do. But as the value of the spread rises, you will be losing money. So the only thing you can say is that you're short the spread.
I got it, sir. I got it.
Okay. All right. Okay. All right. So we have scheduled your tutorial next week sometime, right?
Yes, sir. It is on Monday, 8th Feb.
Okay. All right. Okay. All right. So anything else?
No, sir.
Okay. Take care. Enjoy your lunch. Okay.
Thank you, sir.
So I think the next semester is going to be in the I don't know how it's going to be decided, but it's going to be looks like hybrid kind of